Lesson 13, the Gartley. Before we get started, I'd like to point out a couple things. One, up in the top left-hand corner is that sign, important information. As we go through this lesson, you will see in your workbook and on these slides that this sign appears on certain pages. On those pages, you'll probably find very important information that can help you out in your trading. Also, I would like to point out in the bottom center of the page, there is a number. That number corresponds with the number in the workbook. If you lose yourself, match up your workbook number with the slide number that we're working on, and you should find your place. There are 16 lessons on trading the Forex to help you. These lessons do focus in on technical analysis. These lessons are applicable to other markets where you can pull up a financial chart. Now, as I have said many times before, successful traders will do what unsuccessful traders can't and won't do. This lesson, the Gartley, is an incredible lesson about the natural harmonic vibratory Fibonacci movement of the market that can participate greatly in your success in trading. Successful traders take the time to educate themselves on how the market works, to where unsuccessful traders don't. Unsuccessful traders are trying to become lucky and they're trying to, if you will, gamble in the market. Successful traders have a tendency to go figure things out first. They educate themselves, they understand how the market works, they form a clear methodology and a discipline, and then they start to trade based on that education. I pose this question. As you embark on learning how to trade, what are you going to be? A successful trader or an unsuccessful trader? Take this statement into your life and change the word trader and replace it for the word people. Because I have learned that successful people will do what unsuccessful people can't and won't do. When it's time for you to make a decision in your life, just ask yourself this question: what would a successful person do? This statement can really play a big part in your life. We have the 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information, which means if you don't use it, you lose it. Play this lesson over and over again until you understand it and can apply it to your trading methodology. By the end of this lesson, you will learn that the markets are governed by natural laws, that the markets work in a numerical sequence. You'll learn how to read a price swing and its extension, how to find a Gartley and Fibonacci numerical convergence. You will learn how to trade that Gartley bounce. You will learn how to create a Gartley trading plan and trade that plan. And you will learn where to place your protective stop-loss order to financially protect yourself in every trade. Before we get started, I'd like to review Lesson 1. We are watching Japanese candlesticks which monitor the open, high, low, and close of a time period. We're watching bullish and bearish candles. This is what they look like on a chart. Bullish candles mean the market is rallying. Bearish candles mean the market is reacting and coming down. Bullish candles will be white in this presentation. Bearish candles will be black. This chart right here is a 2-hour chart. Each candle represents 2 hours. Another thing I would like to point out, important information sign right there, that most traders watch a bid chart. This is a bid chart and it is monitoring the bid price. There is a bid and an ask. The bid and the ask are usually 3 to 10 pips in spread in the currencies. In all financial products, there is a bid and an ask. The bid is always lower than the ask price. And traders buy on the ask and sell on the bid. Why? Because buyers buy from sellers and sellers sell to buyers. Now this is very important when it's time to trade, because if this is a bid chart, that means this is the current price, 107.30, which means right at the close of that candle is where the prices are. If I buy right now at the market, I will be buying on the ask. The ask will be 107.35, which means every buy should have two sells, one for profit, one for potential loss to protect yourself, which means our sells will be on the bid. That means that all the candle has to do is come up and hit that price and you will be filled or stopped out. Now, if you are selling and that's your first order and you're shorting the market, you will sell on the bid, which means if we entered the market right now selling, we'd be filled at 107.30 and our buy stops would be on the ask, which means if the market rallied to potentially take us out for a loss as we short this market, you will notice that the ask price, which is higher, will hit your protective stop loss before the bid will. This is where a lot of traders get confused. They think that because the candle didn't hit it, they're still in. Many times the candle will come right up to the actual ask price and a fall, and what happens is the trader has a tendency to feel like, wow, I'm still in. Whew, I didn't get stopped out. But in reality, they were stopped out because the ask price is always higher than the bid. You must understand this in order to avoid a lot of frustration as you trade. There are three types of orders we'll be using. A market order, which is an order placed at the market at whatever the bid or ask price is. A limit order, which is an order placed to enter or exit the market at the exact placed price or better with no slippage. And a stop order, and that's an order placed to enter or exit the market at an exact price that turns into a market order when touched. Now let's look at this chart again. Here is the current price. That's where the market is. Any order placed above the market or below the market will be excuse me, a working open order. It will be an order that's not filled. Now, if you choose to buy above the market, that will be called a stop order. If you choose to sell above the market, that will be called a limit order. These are the rules. If you choose to buy below the market, that's a limit order. If you choose to sell below the market, that's a stop order. Here's some additional ordering rules. Every buy should have two sells. If you're buying, you're a bull, you want the market to go up, you need to have a sell for profit and a sell for loss. Here is the buy on a chart. You should have a protective sell stop loss order and a limit for profit, a sell limit order for profit. Every buy should have two sells. Conversely, every sell should have two buys. If you're selling, you're shorting the market. You're entering the market first. Selling, you're a bear. Your position is short. As the market starts to fall, you will need to come out of the market buying for a profit. And you will need to also place a protective stop loss order just in case the market starts to go against you so you can control your losses. Remember, let's quantify our losses first before we trade. When we quantify our losses, the profits have a tendency to take care of themselves. Every sell should have two buys. Now let's look at this in a chart. If we were to short the market here selling, we then need to have a protective stop loss order, which is at the last high. That is a buy stop. Every sell should have two buys, one for potential loss, one for profit, a buy limit. Now, an OCO is whether we are buying or selling, we need to have two orders, one for profit, one for loss. Whichever the market hits first, it will cancel the other order so that you don't have a working order out there. Please keep in mind, as you cancel and replace in an uptrend, only cancel and replace to the new last low after the market has made a new high. Learning how to properly cancel and replace is explained in detail in Lesson 3 under Equity Management, as well as Lesson 16, Trading Strategies and Their Justification. The opposite takes place when you're chasing the market in a downtrend. Only cancel and replace to the new last low after the market has made a new low. Only cancel and replace to the new last high after the market has made a new low. This is not a greedy way to chase the market. This is a very educated way to chase the market and lock in profits. Technical traders learn to read charts. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. How can that be? I will tell you how that is. People trade in the market. Even if they work for a bank or a financial institution, people trade in the market. People are creatures of habit. We have a tendency to be predictable and repeat our habits. Because we are creatures of habit, charts do nothing more than monitor our buying and selling habits. Therefore, these charts have a tendency to repeat themselves. That's what the study of technical analysis is all about. It teaches traders how to predict the future. Technical analysis is applicable to all markets anywhere you can pull up a chart. And once you've been educated on how to read a financial chart, you will start to control your financial future in the markets. I'd like to do a quick review on support and resistance, which is Lesson 2, so that you clearly can identify highs and lows. A high is the body of a candle or a wick that is higher than the two candles to the left and two candles to the right. And please keep in mind that not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently being traded. Lows are two candles to the left or two candles to the right that are higher than either the wick or the body low. That constitutes a low, but not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. What we want you to do is we want you to learn how to just pull up a chart, have your eyes scan all the levels of resistance and all the levels of support, and have as recall in your head from Lesson 2 the financial game between the bulls and the bears. Please don't underestimate that game. Bulls are trying to establish new levels of resistance and take out all the old levels of resistance, and bears are trying to establish new lows and take out all the old levels of support. All protective stop loss orders must be at the last low if you're buying, and the last low and the last high if you're selling. Now let's look at this chart. If you're, for whatever reason, you place a buy order here, your protective stop loss order needs to be at the last low. Please quantify those stops before you trade. If you can't afford the loss, don't trade. If you're shorting the market, whenever you sell, your stop order needs to be at the last high. So quantify those losses. If the stop order is too far away from the entry point and does not meet your equity management requirements, which are clearly explained in Lesson 3, then pass on the trade and go find another trade. Our focus is survival. Let's review trends and trend lines. This will be helpful in understanding this lesson. Remember, the market moves in price swings, and as it moves in price swings, it has a tendency to make higher highs and higher lows. And when it makes higher highs and higher lows, it is in an uptrend. And when you spot an uptrend, you will draw all your trend lines across the lows of support. Let's look at all these lows. Look at how we drew the trend line across the lows of support. Now, there are three primary upward trend lines. Lesson 5 focuses in on this, and Lesson 5 focuses in on teaching you where to buy a trend line. There's an inner, outer, and long-term trend line. Now, a downtrend works exact opposite. A downtrend is making lower lows and lower highs. See how this low is lower than that low, and this low is lower than that low? Look at how we're making lower lows and lower highs. Whenever you spot a downtrend, you will draw your trend line across all the highs of resistance. See how we drew that line across the highs of resistance forward? Once again, lesson 5 focuses in on teaching you how to trade the long-term the outer, and the inner trend line for profitability. Just a quick review on price swings and their extensions, which is lesson 7, a great lesson that you need to understand before we can get involved in the Gartley. But as we discussed in lesson 7, remember the market is governed by natural laws, and we discovered that the world is governed by natural laws, and that Leonardo Fibonacci in the year 900 AD discovered a numerical sequence. He was the one that introduced the numbers to the Romans. Instead of using the Roman numerals, they now use the numerical numbers. He discovered a sequence that when you add two numbers, they will equal the sum of the next. And when those two numbers are added together, they will equal the sum of the next. And so when you take the previous two and add them to the sum of the next, you come up with the sum of the next. So 2 plus 3 equals 5, 3 plus 5 equals 8, 5 plus 8 equals 13, 8 plus 13 equals 21. We went into detail about that in lesson 7, and then we started to divide those ratios in numbers. When we got to the point where 89 plus 44 equals 233, or anywhere along the line in this sequence, and we started dividing 89 by 144, we came up with 618.618. And when we divided 144 by 233, we came up with 618, and we started dividing 233 by 144 and 144 by 89, and we started to do all this dividing in lesson 7, and we started to come up with some ratio numbers. And those ratio numbers were a 382, a 50, a 618, a 786, a 1.618, and a 1.27. We equated them to percentages, and then we equated them to price swings. And we discovered that Fibonacci ratio numbers are potential levels of support. In an upswing, they become a location where the market should bounce, and that if the market bounced at a 382, 50, or 618 of the previous price swing, as it bounced there, U-turned and rallied and took out the previous high, that it would rally to a 1.618 or 162% of the original price swing. Let's look at this chart. See how the market rallied, it came back, it bounced at a 382, U-turned, took out the previous high, and then went straight to a 1.618 extension. These are the extension numbers, 1.27, 1.618. These are the retracement numbers in an upswing, 382, 50, 618, 786. If you have any difficulty whatsoever in understanding your Fibonacci's, please feel free to call us up as a company. Talk to our customer service department. Make sure that you have a data provider that can allow you to have Fibonacci numbers. This is a very, very important tool when it comes to trading. When the market retraces all the way down to a 786, we learned that it will only go to the 1.27 or 127%. And that in reality, when the market is retracing back to a 786, which you can see here, it is slowing down. Look how much time it took to get to the 1.27 extension. We learned that price swings move at different speeds, that when the market bounces at the 382, it's very aggressive, fast, it's like a car going on a freeway, versus when it's bouncing at a 786 retracement number, it is slowing down. Downswings work exactly opposite, and they work in the same numerical sequence. Fibonacci's now in a downswing become hidden levels of potential resistance. Now, in a downswing, we turn everything upside down. This is the downswing. It starts at a high, stops at a low. As it is retracing, it first meets the 382, then the 50, then the 618, then the 786. And we learned that if the market bounces at the 382, 50, 618, any one of those U-turns takes out the previous low, it should go to the 1.618 or 162%. Look at how this one bounced at a 382 and went straight to the 1.618 extension and bounced. Here's the original swing. These are the retracement numbers: 382, 50, 618, 786. This would be 100%. These then become the extensions: 1.27 or 127% extension, 162% extension, or the 1.618. When the market retraces all the way to the 786, it does not have the energy, as we learned in lesson 7, to go to the 1.618. It can only go to the 1.27. Remember that as the market waves within the original price swing, it is not doing anything more than moving in its natural harmonic vibratory movement, and that this is potential sideways movement in the overall downswing, Fibonacci bounce, and extension. Downswings move at different speeds, just like upswings. They bounce at 382s all the way down to 786s. 382 bounces are very aggressive and fast, to where 786s are slowing down. Now, the reason you want to trade a 618 or 786 Fibonacci bounce in the direction of the trend is just in case the market decides to crown, which is lesson 8, or enter into the buy zone, which is lesson 6. Just in case it decides to reverse, your losses will stay small. Another important information sign is technical analysis is all about listening with your eyes. If you listen with your eyes, look where the market has been, it will tell you where it's going. Look at how the market bounced at the 618 first, which if we entered the 618 bounce here and look at that rally, our profit would be at the 1.618. But instead, it formed this Gartley and that we're going to be talking about, and it U-turned and came all the way back to a 786, which means we now would have to adjust our profit from the 1.618 back down to the 1.27 extension. Please keep this in mind. Remember, look where the market's been, because it will tell you where it's going to go. Now, lesson 13, the Gartley. A Gartley is a price swing and extension movement inside a price swing movement, where Fibonacci numbers match up and create a convergence and potential trading opportunity. Now digest this for a second. The term convergence means a location where there is more than one hidden educated reason for the market to bounce, i.e. trend line, a Fibonacci number, completion of a beat, which you will learn in lesson 14. Any educated location where there is a reason, a hidden reason why the market should bounce is called a convergence. Now, convergences in the direction of a trend are usually big money trades. The market bounces at those convergences. Now, to understand how all this works, let's look a little deeper into the downtrend price swing. See how it starts at a high and stops at a low. That's a downswing. See, starts at a high and stops at a low. Now that we have the downswing clear, lesson 7 explains the downtrend price swing and the extensions. We have a downswing and a retracement and a potential extension. It becomes actual extension when it takes out the previous low. If you can understand this whole move of the downswing, retracement, extension, you have got about 80% of this business figured out. Now, which means this whole move then becomes an entire downswing and extension, which is part of the Gartley. Please, if you need to, pause your machine and understand this. Now let's look at it on a chart. This is the entire downswing. This is the retracement. Look how it came down, took out that low. That's the extension. Now, small down price swings can make up a large price swing. Look at how you have this downswing, retracement, and extension, and look how that fits into a larger downswing, which means you take the same low and back up from the previous high to the next high up to calculate a larger downswing. Now the market moves in waves. Those waves are called price swings. Downtrend price swings start at a high and stop at a low. Two small swings can create one larger swing. Let's look at it in this chart. See this downswing, retracement, and extension? Look how we keep the same low. Instead of backing up to here, we back one more up. That then becomes a down price swing. You learn a lot how to do this in lesson 12, called Trading Fibonacci, Convergences, and Trend Lines. It teaches you how to spread your Fibonacci's and how to calculate price swings. But now, when you put the entire upswing and extension inside the entire downswing, you have what's called a Gartley. Now let's look at this. See how we have an upswing, retracement, and extension, and we have one big large downswing? When you fit a Gartley, when you fit an upswing and extension inside a downswing and extension, you have a Gartley. Now watch how the down price swing and the up price swing and extension create a convergence of Fibonacci numbers. Now, when a price swing, here's a sign, important information, when a price swing and extension moves in the opposite direction of a large price swing and meet to create a convergence of Fibonacci numbers, that's called a Gartley. Now look at how the up price swing and the numerical sequence, because it rallied, retraced to a 5-0. Remember, if it bounces at a 38250 or 618, looks like it almost came down to the 618. If it bounces at any one of these three, U-turns, takes out the previous high, it's going to go to the 1.618. There's the extension number. Now look at how this big downswing is right at the 786, which is the 1.618. This movement is called a Gartley. Now, trading is all about understanding price movement against time. I talk about this in lesson 12, convergences. If we were to draw a trend line, which you learned in lesson 5, look at how you draw your trend line down, and as time eats up, it meets and converges right at the 786 and 1.618. That's called a convergence. Now the Gartley works exactly the same in the opposite direction. Let's look at an uptrend price swing, which starts at a low and ends at a high. This is an uptrend price swing. Starts at a low, ends at a high. Now, lesson 7 explains the uptrend price swing, but remember, you have a rally, then a reaction, a retracement, and when it bounces at a Fibonacci number, it starts to work on its potential extension. It is only when it takes out the previous high that it becomes actual extension. This whole move here then becomes what's called the entire upswing and extension, which is part of the Gartley. See, when it makes a new high, it is now the extension up price swing, and it is also called a rally. Here we go. There's the uptrend, price swing, retracement, bounce at a Fibonacci number, and rally to the extension. Now, you can have two small upswings, or an upswing and extension. See how this could be two upswings, one, two. Two small swings can fit into a larger swing. And the market moves in waves. Those waves are called price swings. Uptrend price swings start at the low and stop at the high. Two small swings can create one larger swing. Let's look at this chart. Market rallies, retraces, rallies, creates a high. Now that fits within a large upswing. You see that? Now the entire downswing and extension is part of the Gartley, as explained in the previous. Let's look at this again. We now have a downswing, retracement, Fibonacci bounce, and extension. Now put the entire downswing and extension inside the upswing and you have a Gartley. See how we put the downswing inside the upswing? Watch how the upswing and the down price swing and extension create a convergence of Fibonacci numbers. See how this rally or upswing, this then was the 786 of the upswing, and it's also the 1.27 of the downswing and extension. Understanding price and time, look at how in drawing a long-term outer trend line, look how the market in the outer trend line slowly, as we eat up time, it moves, the trend line moves up and hits right at the 786 1.27 extension. A Gartley is a formation of a price swing and extension that fits inside a bigger swing moving in the opposite direction that creates a Fibonacci convergence. Now digest that. Here's the upswing with a downswing and extension, or a downswing with an upswing and extension. Now let's go through this trading exercise. Now that I've explained all this to you, you go and find the Gartleys, because the best way to understand what you have learned is to write down what you think you know, then go back after you've been taught and look at what you thought you knew versus what you now know. Your perception's your reality. Remember, these charts are like looking at an X-ray. Our focus is to download our perception and upload it with you so that you can see what we see. So write down what you think you know and see about Gartleys. Go find a Gartley. Put your machine on pause as you go through this exercise. Is this what you saw? See how we have one big downswing and a small upswing and extension, but they both meet at a Fibonacci convergence, which is a 786 of the downswing and a 1.618 of the upswing. Look at the British pound hourly. Put your machine on pause. Find a Gartley. Is this what you see? Look at this big downswing. Look at how the market rallied, retraced back to the 618, and then went to a 1.618, bounced, and came back down. See how it was the 786 and the 1.618? All at the same location? Look at a Euro 30-minute chart. Put your machine on pause and find the Gartley. Is this what you see? See this upswing? And this was the 786, but then it created a downswing with a retracement to 786 and then to a 1.27. Look at how it formed a nice tweezer bottom, which is taught in lesson 11, trading Japanese candlesticks. Now look at this chart and find more than one Gartley. Put your machine on pause, draw them all out based on what you've been taught. Find as many Gartleys as you possibly can. Did you see this one? See how we have the low to the high. There's the 786. There's the down swing, retracement, extension. All this is a retracement of the upswing. Did you see this one? Look at this large downswing. All this rally, retracement, and extension is in reality a retracement of the upswing. But this is called the Gartley. Did you see this one? You have an upswing and a retracement, but in that retracement the market does what's called that Fibonacci move. It goes down, creates a low, retraces to a Fibonacci number, then goes to an extension. That's called a Gartley. Now let's walk through a trading exercise. Turn on your trading software when you're practicing at home. Understand clearly that your trading software is very important to understand before you start trading. You need to learn how to maneuver within the software. Now here's the rules to trading a Gartley. When you turn on your computer and boot up a chart, go and find all your trend lines, your inner, your outer, and your long term, which is in lesson 5. This will help you determine if you are in an uptrend, downtrend, or if a trend line has been broken, signifying the potential end of a trend. Look for a big price swing up or down. Use your Fibonacci tool on your software and draw your Fibonacci lines and find the potential 618, 786 retracement and potential convergence. Find a small swing moving in the opposite direction. Use your Fibonacci tool on your software and draw your Fibonacci lines on the small swing and find the 1.27 or 1.618 extension that matches up with the 618 or 786 retracement of the big swing. Try to find any other convergences, i.e. trend lines, harmonic beats, anything you've learned from the previous lessons. Try to match them up because they all play a part in those convergences. Look at your potential risk with your protective stop loss order. If you can't afford to take a loss on the trade or the risk is too great, you may want to pass. Pull out your trader's checklist and create a trading plan and trade that plan. Now let's face the facts. Every trader wants the market to move in their direction from entry. Watch how understanding how the Gartley works can improve your percentages of success. Now you boot up your computer and you look at your chart and you spot a potential Gartley forming. Do you see it? If you do, start to draw it out. But here's where the market is, right here. If you see it, start to draw it out. Now, according to the rules, we have to now start drawing trend lines. So you draw your trend lines, and now you are confused because you don't know whether the market is going up or going down or going sideways. You're confused. Why? Because we were in a downtrend, but the market broke a trend line, and then it started to rally up, and it broke another trend line, and it was rallying down, and it broke another trend line. So now it's rallying back up. But as you do your homework and you go to a larger time frame, back off from a 2-hour, maybe go to a 4-hour or an 8-hour daily, you find a long-term outer trend line coming across that high. And so you print out, if you can't see this visually, print out the chart and draw your up price swing and the extension that it's working on. Look at that. Look at how this current uptrend price swing, retracement, and extension may hit this trend line. Now, can you find, if this is the uptrend price swing and extension, find the big downswing. This is where you should have drawn your big downswing. Now that you see the big downswing, can you see the small upswing and extension fitting inside the downswing? Now start to draw your Fibonacci lines to find the exact number, because now that we have found a Gartley, we're going to look to enter the market and short the market. We're going to sell here, and we want to know that exact number. So look where the 1.618 extension is. Why is it the 1.618 extension that we're after? Because remember, look where the market's been. We bounced at a 618. Market rallied, retraced, 382, 50, 618, 786. It bounced at a 618. When it bounces at a 618, it should go to the 1.618 extension. Now, the market, if we spread our Fibonacci numbers on the big downswing, we see that all this is retracement, and look where the 786 is. The 786 just happens to be at the same location that the 1.618 extension is at. Now we bring in the down trend line and we find a convergence. See how now at one location the 786 of the downswing is converging, or at the same location as the 1.618 extension and downward trend line. Excuse me. Anticipation is the key to successfully trading the Gartley. When the market is moving to the extension on the small swing is when you start to set up your trade. See how it's taking out this low or taking out that high and achieving a new high or achieving a new low? Now is the time that you start to prepare your trade and start looking for Gartleys. When the market breaks this trend line, and it does it after a small two-wave, that's kind of a rule. When it does it after a two-wave move, start looking for that Gartley formation and start setting up your trade. Start preparing right in here. Start looking for that Gartley. Now pull out your trader's checklist, fill out your trading form, and let's trade a Gartley. The market should bounce at this convergence. Follow the instructions on your trader's checklist. Go find all your support, go find all your resistance, keep a paper record of everything you do on this trading forum, just in case your software goes out, your computer crashes. Here's that important information. If you are going to limit in, and you're not going to wait for the bounce, but you're going to get in right at the bounce, then place your limit order to enter the market right before the bounce so that the market takes you in. Also, if you're going to limit out, place your limit order before it hits that potential extension. And once again, the reason we want to trade 618 and 786 bounces in the direction of a trend is just in case it doesn't work out, our losses will be small. Now, we enter the market. Look at how the market finally rallied. It rallied up to that 618, or excuse me, the 786. It rallied all the way up to the 786 retracement of the downswing. Look at how we can envision where it should go. This would then be the downswing retracement, 786 bounce should go to the 1.27 extension. That's what this is. 1.27 extension, 1.618 extension. Because it's bouncing at the 786, It should only go to the 1.27, not to the 1.618. Now look what happens. The market forms this Gartley, and market rallies to that 1.618 extension of the upswing, 786 of the downswing, and falls. Look at how it fell all the way down to the 1.27 extension, and it stalls right there. Look at how it stalled right there, and it's starting to bounce again. Now this then is our profit. If we got in before our entry and exited before the 1.27 extension bounce, then we made just about 180 pips in profit. That's about $1,800 on one lot. 10 lots would be $18,000. Now if you're going to be out there trading 10 lots and you have $18,000 that you can make within a couple days, don't you think it's well worth your time and investment to learn and understand how a Gartley works? If you listen to the market with your eyes and look where it's been, it'll tell you where it's going. Remember, because it bounced at the 786, it went to the 1.27 extension. Look at how that 1.278 extension became the 786 of this upswing. And look at how the market hit that 1.27 and bounced back. It's already rallied close to 90 pips already. Your software will figure out your P&L statements. As you use the software, please keep in mind one thing. It monitors your success and failure. Please create a habit of trading successfully before you open up your own account. Figure out your P&L statement, print out the chart of what you did up above to keep a record so you can go back and review. Now, one of the most amazing things, that's why in recording this, we've gone back and we've recorded it because of this situation here. On September 11th, 2001, terrorists attacked America. Even with all the chaos in the world, the financial markets moved in a Fibonacci numerical sequence and even formed Gartleys on the day of the attack. Now, the currency market never closed. The stock market closed for a week, but when it reopened, it responded in a numerical sequence. I'm going to show you these things on a chart. Seeing is believing. On September 11th, 2 planes hit the World Trade Center. 1 plane hit the Pentagon. Another one went down, trying to hit another federal location. The market responded. This is the Swiss franc traded against the US dollar. When the Swiss franc drops, it increases in value. The dollar weakened against the US dollar. As the Swiss franc dropped in numerical price, it increased in value. But when it fell and finally stopped, look at how, as it retraced back to the 382 of the big downswing, but then created a new small upswing. It rallied, retraced back to the 786, rallied again. When it goes to the 786 and bounces, where's it going to go? To the 1.27. Look how the 1.27 just happened to be at the 618 of the downswing. Even with all this world chaos, the market still moved in a Fibonacci Gartley sequence. Market goes up, hits the 618, which then become the selling opportunity. Look at in shorting the market at this convergence or at the termination of this Gartley, how the market fell. Not only fell, but it fell 200, 700, 800 pips, which can equate on the Swiss franc. 800 pips can equate to about $5,000 on one lot, or $50,000 on 10 lots. Look at what it did on the euro, Japanese yen cross. The euro yen cross, what happened is the planes hit the tower, the euro yen fell, bounced, retraced all the way back up to a 7/86 of this downswing, but creates a large upswing. And look at how, as it moved all the way back down to the 7/86 of this upswing, look at how it moved in a Gartley fashion. There's the downswing, there's the retracement to the 618 or 7/86, there's the extension to the 1.27, and then once again formed tweezer bottoms, which is lesson 11. Here's a trading opportunity, a convergence, a location where several educated reasons for the market to bounce take place all at one location. A 7/86 bounce, a 1.27 bounce, a tweezer bottom bounce. Even with all that chaos, the market formed a Gartley. Look what it did on the euro 30-minute chart. Market rallied. This is the euro, which means it's traded against the US dollar. A rally on the euro means it's strengthening, the dollar's weakening. But after it finished rallying on September 11th, here's the date, September 11th, it rallied, it starts to retrace. As it retraces, it forms a Gartley. Look at how it retraced all the way back to the 7/86 on the downswing, then moves to the 1.27 extension, which is the 7/86 of the upswing, and it forms a Gartley. Here's some additional information I thought I'd just show you and share with you. Look at what the Dow did. On September 11th, the Dow was in a downswing anyway. It was waving down previously. Look at how it waved down, went to a 618 of that swing, had already come down, bounced at a 1.618, bounced, U-turned, and came all the way down to a 1.618 of that extension. But remember, the stock market stayed closed for a week. As soon as it opened on this swing right here, as soon as it opened, look at how it went straight down to the 1.618 extension, bounced, then U-turned and fulfilled the 2.618 extension from this swing. See this swing? This is the 1.27, 1.618, 2.618. Look at how it went to the 2.618, bounced, and continued to fall. All this, amidst all that chaos, still worked within a Fibonacci numerical sequence. Look at the S&P. S&P did virtually the same thing. Right at opening, it fell straight to the 1.618 extension. There's the move right there. There's the swing, the latest swing. It bounced at a 382, went to the 1.618. Look at how the 1.618 happened to be the 2.618 of the previous swing. Here's the previous swing. There's the retracement to the 618. This then became the 1.27, 1.618, 2.618. Look at where it bounced, right at the 2.618. Look at American Airlines. This is amazing to me. Here's the latest swing. Market is dipping, finishes a swing, closes for a week. Right at opening, the market falls. This is American Airlines. This is the airline that one of their planes went into the World Trade Center. Look at how even their stock, as it fell within a numerical sequence. Bounced at the 1.618 and then continued to fall. Learning to trade and learning the natural formation of the market can dramatically improve your percentages. We have printed out once again the rules to trading the Gartley. Let's all agree, if you're going to be successful trading in the market, you've got to have an edge. You need to educate yourself so that you know where to get in and why. You need to educate yourself so that you know where to get out and why. You need to know and believe that there are natural laws that govern the market, and that when you enter at a 618, 786 convergence with a 1.27 and 1.618 extension or Gartley formation, it creates a greater possibility for the market to move in your direction from entry. Let's all agree you've got to have a trading plan, and then you need to trade that plan. Now, did this lesson teach you that the markets are governed by natural laws, that the markets work in a numerical sequence? Did this lesson teach you how to read a price swing and its extension, and how to find a Gartley, a Fibonacci number convergence? Did it teach you how to trade the Gartley bounce, how to create a Gartley trading plan and trade that plan? Did it teach you where to place your protective stop loss order and how to financially protect yourself? If it didn't, go back and play this lesson over and over again until you understand it. Now, because of this reality that only 10% succeed who try to trade on the Forex, and 90% lose, because this is a zero-sum game where losers pay winners, success only comes to those who dedicate themselves to really educating themselves on how the market works. And successful traders take the time to educate themselves. Look at how just understanding how the Gartley works places trades in your favor as you trade. Now, there's only two ways to pay for your education. One is to try to go get lucky. Now, if you go out and you get lucky and you end up making money, congratulations. But I promise you, your greed will drive you to the point to where you got to do it again. And it'll only be a matter of time that you'll become unlucky. The real bummer part about becoming unlucky is once you lose all your money, you really have not been educated on how to get it back. Which brings us to the second reason, or the second way you can pay for your education, and that is mentorship. Working with a mentor, working with somebody who understands how the market works. We here at Market Traders and ForexTips.com, we understand how the market works. Understanding how the market works is like buying a map to a gold mine. Because, trust me, there's gold in them there hills. And educating yourself on how to extract that gold can become quite profitable. Because you learn where to get in and you learn where to get out, and you learn the why behind those reasons. Because let's face this fact again, every trader wants the market to move in their direction from entry. Educating ourselves on how the market works places us in a position to enter the market and have it move in our direction from entry. And that's what we all want. We don't want to watch this market go against us from time of entry. In this series, there's 16 lessons on trading the Forex that can help you. They do focus in on technical analysis, and once again, it's applicable to other markets, this education. They all come with trading exercises so that you can practice with pretend money and software, so that you can practice with that pretend money before you enter the market with real money. Doctors operate on cadavers first, don't they? Trader's mantra: I will educate myself on how the market works. I will learn how to trade and place a trade. I will trade with equity management. I will never trade without a protective stop loss. I will not chase the market. I will be patient. And if the market does not meet the criteria of my education and my trade, I will not trade. I will pass on that trade and I will go find another trade. That's where success comes from. And because we're looking at charts, because this does require some spatial intelligence, remember, if the chart is not clear and doesn't visually make sense, when in doubt, stay out. ForexTips.com has a chat room. If you are in doubt, go into ForexTips.com. Ask us, We'll turn on the chart. We'll look at that chart. We'll review the chart with you. We'll give you our analysis of that chart. But if you are in doubt, stay out. And because of this 21-day 3% rule, play this lesson over and over again until it becomes a part of your methodology. We want you to be operating at 85 to 95% recall as you trade with your real money. And this is the reason why. You have worked hard for your money, you have saved your money, and you now want to take that money and put it in the market so that that money can make you more money, because that's what success is about. Having money make more money. But unless you properly educate yourself on how the market works, you will not have a fighting chance. So on behalf of your hard-earned money, and on behalf of your family, and on behalf of everybody here at Market Traders Institute Incorporated and ForexTips.com Incorporated, we'd like to say thank you for taking the time to educate yourself and investing in yourself. Thank you.